All right, welcome back. It's me, Kent Lindstrom, the host of this, the Something Venture podcast. Going to address something here at the top of this podcast. It's a great episode. Samir Kaji is on today. A number of people have said, and I never even thought about this, they've said, you never tell us who you are on the podcast. Everyone else talks about who they are, and they try to sell me all kinds of different undies and all kinds of things, and you don't do either of those. And that's true. So I will tell you who I am. For those of you who haven't thought to Google it, I am on the internet. I am the co-founder. I'm a venture capitalist. I'm the co-founder of a venture firm, a seed stage venture firm called 8-Bit Capital, which I founded with my partner, Jonathan Abrams. We invest at the seed stage, and we invest in startups that connect people and businesses in new ways. And if you want to learn more about that, there is a website for 8-Bit Capital. So thank you for bringing that to my attention. I will be better about that in the future, but that is who I am. And today, we have Samir Kaji on, who is a guy, I think the theme of this podcast, I'll say, is a guy who has unique perspectives in two ways. And I'm using that term not in more in the term in the sense of a vantage point. And so he's building a company called Allocate, and he'll explain what that is. But there's a lot of venture capitalists in the world. There are a lot of what are called LPs, limited partners, the people who invest in venture capital in the world. Hundreds or thousands of both of them, certainly, on each side. But there are very few people who sit in the middle of those two things and who can see both perspectives, who can look over the mountaintop and see the desert on the one side and the ocean on the other. Samir Kaji and what he's doing with Allocate are one of those things. So that's thing number one, the perspective that he has. The second perspective that he has, that we'll talk about a bit here, that is interesting, is this. Samir spent a number of years working at Silicon Valley Bank as an executive, and then he spent a number of years working at First Republic Bank as an executive. Now, if those two names sound familiar to you, it is because both of them spectacularly blew up earlier this spring. And it sort of seems like a fever dream now, but it happened. And Samir, having worked at both of them, has a, like I said, unique perspective on both of them. So you're going to enjoy this episode. Samir Kaji is my guest. Now you know who I am. It's Something Venture Podcast. Thanks for being here. Thanks for listening to all these episodes. I appreciate it. Welcome back. All right, welcome back. This is the Something Venture Podcast. I am Kent Lindstrom. I am your host. My guest today is Samir Kaji. How you doing?
Doing good, Kent. Great to see you, and thanks for having me on.
Well, thank you so much for doing this. So Samir had quite a great normal career for for a while. He started out at Silicon Valley Bank, which is a bank here in Silicon Valley that, not surprisingly, that services the venture industry service. We'll talk about what they're doing. And then First Republic, this is a perfectly normal career. And then he threw it all away to become an entrepreneur for some reason. He is the founder and CEO of Allocate, and the host, I think, of the Venture Unlocked podcast, right?
Right, that's right.
And so we always hear you talking, very articulately about, allocating capital and the venture world. But I want to start with you. What's going on in your young life? You didn't sow many wild oats, it doesn't seem. It seems like you went right away to Silicon Valley Bank here in Silicon Valley and moved right up the ranks, like you probably should, but like not a lot of people do.
Yeah, I had, and I'll go back a little bit further, actually. So my dad was a first generation immigrant from India. He came in the early 70s. I was born in Canada. My dad was a civil engineer and realized he had a bug to actually build businesses. He wanted to be an entrepreneur, and he left, sort of the safety of working at a really nice, big company as a civil engineer, and decided to get into commercial real estate in the mid 70s. And ultimately, at the time, first generation guy, didn't really have a network, and he basically called everybody in the yellow pages to figure out who would give him a job. Finally got somebody in Virginia Beach to take him on. And ultimately, my dad became, partner with the guy. And eventually my dad became the sole partner. And then that led to a long career in terms of, starting and building a real estate firm. So in the 80s and 90s, my dad used to take me out to his different trips. So he had properties everywhere, Dallas, Fort Worth. I would come with him and I'd see him work from 6 a.m. to 12 midnight. And not once did he seem tired. Was incredibly energetic. And what stood out to me at the time was he just loved what he did. And so when I graduated college with a degree in finance, I actually had the opportunity to join my dad in the commercial real estate business, but ultimately saw what was happening here in Silicon Valley. We lived in Silicon Valley at the time, and after college, I had this job posting pop up, and it's Silicon Valley Bank, work with entrepreneurs. And I said, hey, this is a pretty interesting way to work with, people that are building things and maybe forge my own path. And ultimately got the job in September of 99. They were hiring anybody with a pulse. And remember, this is at the tail end of the dot-com.
That's right.
And so I was lending to these companies that were at the earliest stages. And I had the great fortune of meeting Google when it had less than 100 employees during that time. Stayed there at SVB for 13 years, worked with a number of great founders. I met LinkedIn when it had less than 10 employees. Had no clue that they were going to become anything that, of course, they've done. This is right after they got the first round of capital from Sequoia Capital, and just really fell in love with the entrepreneur route. So being around entrepreneurs every single day, seeing the grit, the hustle, and the tenacity of building something for a future they believed in really was really exciting to me. When I moved to the private funds group in 2008, I went kicking and screaming. I didn't want to work with VCs. I wanted to stay working with entrepreneurs. And Ken, you probably remember this, but around that time, there was this term that was coined, super angel. And these were people that were kind of raising smaller funds. Many of them were ex-operators. And in 2010, it became very clear that the venture industry was changing. Companies were able to form and get to market more cheaply because of mobile and cloud. And ultimately, I saw more of these funds come to market. And I said, these people feel like entrepreneurs. They're writing checks versus code. I really want to build a business around that. So I left to join First Republic. And I feel like it's a little bit of a punchline now, given what's happened over the last 4 months in the banking industry, but really focused on emerging managers, helping emerging managers get off the ground, build their franchises. Spent about 8 years there. Was grateful to work with, folks like yourself and others. And ultimately, saw this, problem set that emerged, which was the difficulty of the private wealth sector and venture managers really working together in an efficient way. And so Allocate was, built as both I had to be an entrepreneur.
Yeah.
It was something that I always wanted to do. Had the opportunity to do it in some way within a big organization at First Republic as the first employee as part of that group. But ultimately, I wanted to build, again, a future I believed in, which is a venture market that did not disadvantage the individual investor. So we started the company in July 2021. The word democratization is used. I don't think about what we do in that way. I think about how do we create the overall infrastructure and the guide rails to allow managers and allocators to operate in a more transparent and accessible market. So been around.
And how did you resist all this time? Because I worked at Deloitte in Silicon Valley, and it was probably a similar thing where you get to see all these amazing people building. You don't end up at Deloitte if you haven't done something a little bit right, in your company. And I was like, that just looks like a really fulfilling thing to do, and that's how I became an entrepreneur. How'd you avoid joining LinkedIn or Google or something along the way?
At SVB, you do get to work with some amazing people. So I was able to learn from a lot of smart people within the organization, as well as the clients. And, fundamentally at the time, I was still trying to figure out what I wanted to do and to be availed with so many different people. I mean, I was managing relationship books. There were, 100, 200 different people. And that gave me such a great way to have mentorship within a big organization. First Republic was very much the entrepreneurial type of institution. I remember the first day I got there and I said, hey, so what do you want me to do? Here's my thesis. This is what I want to build. Like, yeah, you go figure it out. If you don't do it, you're not going to be here. But, go try this. And if it works, great. Like you'll continue to build. So I felt like I had the opportunity to work with entrepreneurs, learn from them, join First Republic, actually build a business, which, at the end was a very, very large business with over 50 people. And so I felt it. But at the very tail end, I just realized I like to build. I like to be at that 0 to 1, 1 to 2 level versus, at a mature company. And so the time during COVID,
Yeah.
allowed for a lot of self-reflection. And it was just very clear at the time I had
Yeah.
to take that big swing for myself.
So let's explain this to people, because there's people all over the world listening to this podcast with different levels. They're all interested in Silicon Valley, may not be expert in it. So there's all kinds of people who want to raise a fund, they want to raise capital and invest in entrepreneurs. And they have all different reasons that they think they would be good at it. Some legitimate, some maybe not, but whatever. There's a bunch of people who want to raise capital. And then there's a number of pools of capital in the world, in things called family offices, which is a family's become wealthy. They sold a business and they have, you know, $200 million or $800 million they need to manage over time. And if you understand, portfolio theory tells you that at some point you should put 5 to 10%, 2%, some portion of that into an asset class called venture capital. And while there's hundreds of people who have those funds, and the funds that want to invest in entrepreneurs, and hundreds of people who want to invest in them, there aren't many people like you who can connect the two. And so there's a crazy, chaotic process for how these two groups may come together. There's a dynamic where the family offices don't necessarily want to be found by these fund managers, but they want to find the right ones. So there's a weird problem in the world that most people probably didn't realize existed, and you step in to solve it, basically.
Yeah, and so you're 100% right. So in fact, if you look at the current stats, there's about 7,000 VC firms globally. That's up about 4x since the global financial crisis. Many of them, of course, are on the seed stage side, raising a fund 1, fund 2, fund 3. The number of family offices has increased over 10,000. If you look at ultra high net worths, again, over 70,000, ultra high net worth being, over about 30, 35 million in investable assets. Over the last decade, we have seen people dip into the private markets, more commonly called alternatives. And the reason is, of course, the length of time companies stay private. Today, 87% of companies with 100 million and higher in annual revenue are private companies. And so unlike 40, 30 years ago, where you can just wait until companies go public, you have to dip into the private markets as part of your portfolio. We think it as a way to get into transformative companies well before they reach that 20, $30 billion valuation mark. So family offices, you're right, they don't want to be found, but they want to find the right deals. Historically, though, family offices have operated in venture in a way that's been opportunistic, ad hoc, and it's based on first degree connections of what they see. So generally speaking, they see a limited, a network of opportunities. That's really difficult when you're investing in an asset class that really requires you getting into the top quartile, top decile pretty consistently. Second, ad hoc, opportunistic doesn't allow you to build a portfolio that is programmatic, that has vintage diversification, manager diversification, and a really nice split between. So what we provide those family offices is complete transparency of, Kent, you're a family office. I'm going to craft a strategy for you. And through our technology, you will be curated opportunities that make sense for your portfolio construction. You will have the ability to pick and choose. You will get all the diligence. You will get all the information, the manager. And then from there, you can engage, with the appropriate manager. So think about moving what used to be wealth management for public securities, now moving to wealth management for alternatives with the subsector and where we focus on, which is venture capital.
Yeah, and the thing that I think you're describing that has emerged is that when Microsoft went public, I think it was worth $400 million or something, and if you invested there, you would have, whatever it's run up to $1 trillion. And today, somebody invests in Airbnb at a $10 million or $20 million valuation. And think of the value that's created between 10 and 20 million. This is why I get excited about seed investing. Think about the value that's created between 10 and $20 million and the $20 billion it's worth at the Series B or C, where you can actually, we can get this later, but where you can actually sell your stake that you bought at $10 million. It's a, it's an asset class that you look at it, you're like, okay, hard not to be involved in it. And you've met your, son's college roommate who's got a, a Web3 fund, and maybe you want a little bit more. And that's where you come into the mix. Why do you think there's been an explosion of people starting funds since the crash? Like, why? I get why more people have become wealthy and started family offices. Why is the other side taken off so much?
So I think there's probably two things driving it post global financial crisis. I mean, one is pretty obvious, which is, we are in a zero interest rate policy environment. There was no yield to be had. So money that used to go to fixed income had to be deployed somewhere else. And as the bull market went longer and longer, there was more liquidity, there was more need to deploy capital. So ultimately, a lot of it did go into areas that could produce alpha, venture capital, private equity. So there was just more capital. And if you look at the private wealth growth over the last 14 years, now private wealth is about 50% of global assets, institutions being 50%. And it's hard to invest when you have a 3-month treasury that was less than 20 basis points for so long. And so there's a lot of just dispensable capital. But I think the other thing we've seen is just the transition of wealth from baby boomers to Gen X and millennials, both in terms of generational succession, but also a lot of people that were generating wealth came from the technology industry. And so when you know the industry, you see what happens. You have a network, you tend to want to invest in those things. And so the Gen X millennials have been much more open and amenable to invest in illiquid assets. And so that's driven it. The other thing is the number of funds that have come to market. I mean, mobile and cloud were huge catalysts. I mean, you and I probably remember, 25 years ago when you started a tech company, you had to buy servers.
Yep.
And you had the first several million of dollars just go to buying servers. That created barriers in terms of fund sizes and the check sizes that you needed to write even at that first round of capital for a company to actually get product to market. And therefore, those, two things, mobile cloud, along with the overall macro picture and the shift in generational wealth really drove so much capital flowing into venture, and a lot of it being from the family office, both funds and directs.
Yeah. Well, and I think it also became the case over time, and maybe we weren't paying attention while this happened, but it used to be, you invest in a company and it grows and it gets sold for $600 million and everyone's thrilled. Something happened along the way that the actual thing that can happen, and don't expect this, this is very unusual, it's an outlier, whatever. But the thing that can happen is a company can be worth $1 trillion. That is now in the opportunity set, and it wasn't. So when you invest as a seed investor, and the whole world is in front of you with this company, that it's an amazing person and it's an amazing market, and you think what could happen is a lot bigger than it used to be.
Well, it's much bigger because the distribution's there, right? And when I started my career, there's a couple 100 million people on the internet, and you were on maybe an hour a day, and typically you're on through a dial-up modem. Now over 5 billion people with smartphones. I mean, distribution's there. Technology is not only being adopted, it's fully embraced. And so the ability to scale, through being on everybody's compute every moment of the day allows these companies to grow and scale. I mean, technology and money are two things that can be almost infinitely scalable. And so now we are seeing companies go from 0 to 100 million in a speed that we've never seen before. And there's a great chart, I'll share it with you afterwards, where it showed the average time to get to 100 million in revenue. It used to be 10, 11, 12 years. And now we've seen companies like Slack, for example, get there in less than 3 years. So we're just in a different quantum right now. And unlike traditional businesses, software businesses are great gross margin businesses, 80 to 90% margins. Therefore, these can be very valuable companies over time. And we've seen, $1 trillion companies. Now, still massive outliers. I mean, to even build $1 billion company, I think we've probably been a little bit misled by the number of unicorns. We know that many of those unicorns were really a function of the capital markets versus the fundamental value of those companies. But it is very true that, the $1 billion number in terms of an exit isn't what it was, 15, 16 years ago when that truly was a rare occurrence.
Yeah. Well, and I think, in contrast to 1999 or 2000 or whatever, when companies had crazy big valuations, the valuations of those trillion or multi-hundred billion dollar companies are based on the even more astonishing thing that they're generating cash flows of tens of billions of dollars. It's not like, oh, NVIDIA chips are going to be, they're neat. Like someday people are going to use them. It's like, no, they just announced a quarter where their EBITDA was like off by 100%. And it's billions more of cash flow than you
That's right.
expected. Like that's what's happening in this world, which makes it, I think, so exciting. What, as an LP looks across, they're coming into this and they say, I want to invest in venture capital. What are the pieces? There's kind of you can put your money in a big firm like Sequoia and that'll do something. There's sort of XYZ firm that's on their 10th fund. And then there's seed funds. How should somebody think about those? Should they decide that there's one of those things they want to be a part of? Should they diversify across it? How should they come to the world of venture capital before we talk about seed firms, which I'm interested in particular?
I think first of all, you have to, look at sort of the incentives of the underlying investor. Every investor is different. So whether you're an institution, an individual, family office, I think we tend to put everything in neat little buckets. But what's true about any investor is they have, their own unique variables, cash flow needs, risk tolerance. What are their return hurdles? Ultimately, I think the biggest mistake, people do make is still view venture as this monolithic asset class, when in reality, you mentioned seed versus that fund 10 that's raising 2 billion. Those are completely different financial products with different risk return and volatility measures to them. So for somebody looking at venture, we look at it in a few buckets. So there's the big bulge bracket funds. Those have actually moved more toward mass finance, raising anywhere between, 3 and $20 billion per fund size, the Insights of the world, the Andreessen. The financial product of that is very different than a financial product of a fund that's raising $30 million. Risk return, obviously with smaller funds, you have a higher chance of getting top end MOIC and DPI. Bigger funds offer a little bit more stability, of course, less risk. And if you look at the portfolio construction, a big firm may have roughly a third or maybe even less of their capital in that initial investment. And the rest is really investing at that series B, C, and D. So again, different liquidity profile. When we talk to investors, we just want to understand exactly how are they thinking about their, overall sort of portfolio initiatives. How much risk do they want to take? How important is liquidity? A balanced portfolio would have both, right? So, you have some end of the barbell that's really focused on, the bigger funds. You also have maybe a bucket for those mid-sized niche firms. And a niche firm could be somebody that's focused on fintech raising a $300 million fund. It's hard to imagine, though, at least from my purview, and I also am an investor in a number of funds, is not having any type of seed. So again, is what Series A used to be. The overall top end upside, because you're buying at the cheapest point possible at these companies, you can get really those real outlier type of returns. And ultimately, the way we look at seed is you have to be comfortable with your diligence. So many seed funds. How do you know if a seed fund has a probability of driving that out level performance? Because the average seed fund still will average about a 2x net return. And that's simply not enough to take into account the illiquidity premium and the additional risk premium you have when investing in largely unproven, maybe fund ones or fund twos.
Yeah. And why is everybody mad at seed funds? It seems like every time I hear people talking about seed funds, there's too many of them. I think I just heard that seed investing is done. It's over. That's not happening anymore. I mean, if you think about this ecosystem, these funds raising billions, I'm talking my own book here, but these funds raising billions of dollars, what those guys want to do is put $20 to $50 million into companies or $100 million into companies that have been massively de-risked. Those companies only exist because, and yeah, these guys put together their seed programs and they've got their incubate. They don't want to do that. They want to put 50 to $100 million in these companies. Those companies exist because some seed firm went out and invested in 20 companies, and 8 of them failed and 8 of them did well. And a few of them, went. That's the product that these guys need, is the seed firms. And yet the kind of the zeitgeist in the last few years for seed firms, as the market has come down, seems pretty negative.
So I think there's probably a few things potentially contributing to that. So number one is just the flood of seed funds. And it did feel like a little bit of a free for all where anybody that thought venture was interesting would just go and raise a seed fund. And there were a lot of managers, and you've seen this, raise, through things like, Twitter. And, there's a lot of people that I don't know that were really committed to being a good fiduciary and actually not raising a fund, but actually running a firm. And there's two different things.
That's right.
And so, the consequence of easy money is you had a lot of people advantaging themselves because of that easy money policy and raising funds, doing it part-time, talking about numbers, collecting logos. And I think, when the tide goes out, you start to see those things. And as human beings, we tend to overestimate recent history and not look at sort of the bigger picture. And so I think a lot of people have been burned by things they've seen, whether it's poor reporting, poor performance, a bunch of companies that turned out to be vaporware that were invested by people. And many of these folks decided, hey, I'm not I don't want to be a venture capitalist. This is really hard. There's a long feedback cycle, and it's going to take me 10 years potentially to get into carry. And, they go quietly to sort of, start a company or become a product manager somewhere. And I think a lot of people see that and say, well, I got burned during that time. Therefore, this is not a good thing. When in reality, seed investing, I think, is going to continually be a very institutional class, continue to be the time where you, again, are getting into companies at the very early stages. And to me, it's the purest form of venture capital.
Yeah, my sense is if you do it right, people don't, you don't say anything's not, of course it's risky, but if you kind of understand portfolio theory and understand what a seed investor is doing, so they're picking a market like software. Within that market, they're picking massive markets like cybersecurity that are clearly not going to, are clearly growth industries. They're picking a story that makes sense. They're picking an amazing entrepreneur. Then they're doing that 25 or 30 times. The odds that if you do that really well, you just now maybe if you're doing crypto or something, where it's not as clear, it's a problem. But the odds that it's just a wipeout or a zero, in the way that if you do an angel investment, it could very well just be a zero, are lower than probably people perceive at this stage.
Well, I mean, it's very unlikely, especially with a portfolio of 25 to 40 companies, which is typical of a normal seed. In fact, once you get to about 23, 24 companies, you get about 85% of the diversification of like a really big portfolio. And even if we look at some of the worst times ever, so, again, going back into, the benchmarkers are there, PitchBook, Cambridge, you can look at the bottom quartile and say that, the worst 25% of the funds, one of the worst years was negative 2.7%.
Right.
That wasn't negative 100%. It was negative 2.7%. Now, granted, that's not a great return. But people forget the volatility of the public equities market. Actually, if you just put money in the public equities market, there's so much volatility year after year. In the equities market, people tend to buy at the wrong time, sell at the wrong times versus a long-term buy and hold. So having a complete bagel as a venture fund is very, very rare. But that's not really the question. The question is, if I invest, am I going to get the type of alpha for taking on the additional risk and a liquidity premium? And in venture, that 2.5x net firm based on sort of historic paid in capital versus distributions gets you about a 17 to 22% return net to LP post carry.
Yeah, exactly. And so and as you look at funds now, there's thousands of these funds. There's been a trend in the past few years, people trying to get funded to become a specialist fund. Mm-hmm. Can you explain sort of what a specialist fund means? Because if you think of a sector fund, for example, I'm not sure it backtests exactly, right? That Google wasn't actually invested in by a search focused fund, or Uber wasn't benchmark. It wasn't a, mobility fund. But I think you've said that specialization is the key going forward. How should we think about a specialized seed venture fund?
Yeah, I mean, if we go back in history, I mean, most firms actually started off as fairly generalist in nature, right? So invest across all aspects of technology. And maybe 20 years ago, that made sense because there just wasn't enough adoption and there weren't enough industries being affected or adopting technology at scale. Of course, that's changed with what we've seen over the last 15 years. So being a pure generalist can be very difficult from a competition standpoint, differentiating. Um, Oftentimes, the best entrepreneurs or the most interesting entrepreneurs, you have to provide something very unique, but you also have to see something that others don't. So whenever I think about a specialist, do they have something a unique point of view that peers into the future that allows them to invest in things that before everybody else sees it's obvious? And right now, like we see a lot of AI funds popping up. And ultimately, I think if you're going to start an AI fund right now and you haven't done anything in the past, it's probably too late.
But if you were doing Web3 last year and you switched to AI, is that pretty good?
No, it's not. Well, let me put it this way. So what we look for when we look at a specialist, and a specialist could be a number of things. It could be a sector focus. It could be a geographic focus. It could be a theme that they're uniquely, and a theme could be future work. What you're really looking at the manager and understanding is you're asking the questions of why, who, and how. And the why is like, why do you think this is a very unique area for you? Why do you think you're uniquely positioned to execute on it? How are you going to execute on it once, you start looking at companies investing? What is your decision, framing? And then ultimately, when you do, start investing, how are you helping these companies get to the next level? Because over time, that founder NPS is going to drive more value and more, interesting companies your way. And then most importantly, what we look at is what is the driver and the personal incentive of going after this? You like an entrepreneur, we talk about founder market fit. We look at GP thesis fit. Like you can be in the hottest area ever, but if I can't really map back exactly why you're doing this, what's special, what's your unique point of view, how you're going to execute, it doesn't matter if you're specialist. To me, specialist it is a way that people started to say, I'm differentiated, but that's not differentiation. That just means you're doing something that's, you've defined, but you haven't differentiated on why you.
Yeah. And how do you think about AI? I mean, there have been exciting technologies that have emerged over time: the internet, mobile, cloud. AI does feel like one of those on the one hand. On the other hand, there does seem to be a bit of a quick hype cycle on it. How do you think about AI? Or are you just like, that'll just, technologies come and go, that'll just take care of itself?
So we have to separate these two things, right? So from a technology standpoint, I think AI is going to be the one of the biggest innovations we've seen in modern history. I don't think there's any doubt in terms of the speed, the pace, the all the applications that are going to happen, and really the disruption, both good and bad, that it's going to have on society over the next, 3, 5, 10, 15, 20 years. I don't think there's any question. When you do have these times, we've seen this time and time again, you have investing cycles. And what's happened right now, if you look at sort of the funding market, of course, it's very tough, excluding AI. If you were an AI company, not only are you able to raise, but you're able to raise large amounts of capital at very high valuations. But you have to look at the incentives of a lot of the GPs. If you hit the right AI company, we mentioned the size and scale of companies, you can have the next, not just, billion-dollar company, but 10, 100 billion, a trillion, potentially even $1 trillion company out there. So you just have to hit one. And so that's why people are building a portfolio of these interesting ones. There's going to be a lot of misallocated capital here. No question about it.
Yeah.
There, and this is what happens during hype cycles. You have a lot of entrepreneurs also saying, oh, let's just do AI. And then you ask the question of like, well, why does AI make sense in your business? What is the application? What is your moat? What's defensible of what you do? And I think a lot of people have figured out there's a lot of companies that have built AI companies that have been funded with no defensible moats. There's nothing there.
Right.
And so this will work out. We've seen it before with the internet. We've seen it pretty much with every major trend that's emerged. Remember with mobile, there was what was it called? Mobile. It was like local, I
Yeah,
forget.
oh, solo mo or
Yeah,
something.
solo mo.
Yeah.
It's been so long I
Yeah.
forget. But you're always going to have these investing hype cycles. What you're really looking for are investors that have a unique point of view that can cut through the hype. And we're fans of people that invest in AI, but are they investing in AI with an informed and prepared mind of what they believe is going to happen?
Yeah. Well, and there's a funny thing going on right now too. And again, I'm a seed investor, so you'll get the bias here. But a series so if AI has just come to the fore as a, really viable technology for a company, it would make sense since it's been since, the fall, that all the AI companies would at this moment be at the seed stage, just naturally because they only started 6 months ago. If you're a Series B firm trying to jam money into an AI thing, why would it exist? Like, you're forcing it to exist. That's why you're putting hundreds of millions of dollars into things where people go, "What the heck is that?" So it seems that the Series A and B firms just need to wait a couple of years until the seed firms do all their work, and then they can invest in AI firms.
Yeah, although, in the seed market with an AI, we have seen seed rounds done at 40, 50 million dollars,
It's
not valuation, but size, right? And so it's a way for them to come and do that first round, but still get their, allocation of what they want to do in terms of check size, right? Because Mike Maples has said this many times, and I agree with it. Your fund size is your business model. And ultimately, if you have to jam 50% to get 20% ownership, and these, by the time they get to Series B, you're not going to be able to do that. You have to go earlier and earlier. That's why a lot of these AI companies actually skip, the traditional seed round of 3 to 5 million raised.
Yeah, it's a tough. I don't know. It's a tough place to be. We've seen amazing AI things at $10 and $12 million valuations with great entrepreneurs who are smart enough to kind of understand that it's much more fun to have a $10 million valuation, hit some milestones, then 25, hit some milestones, then 50, as opposed to like raising the 50 thing where you're just sitting there going, "Man, we've got to, achieve seed, post seed, Series A and Series B goals before anybody cares about us again."
What you're actually hitting on is also, one of the consequence of the financial ecosystem of venture is we tend to sometimes adopt our funders' business model versus running around. So you think about, once you raise 50 million, you are on a certain path. You have to deploy that capital in some period. You have clear milestones that you need to meet. So companies tend to start jumping on a treadmill that might be at a speed that they're not ready for. A company is not actually healthy for the company. Same actually with LPs and GPs. LPs had so much capital, and you've probably heard this before from institutions. Hey, Kent, this is great. You're raising 40. We'd be totally interested if you raised 100, 150.
Yep.
And some people actually did that. And once they did that, they realized at $100 million fund size, assuming they were able to raise it or 150, whatever comparative advantages they had at 30 just went away. And now you've adopted somebody else's business model. You have to put money to work in a certain way. And you're right. I mean, the smart entrepreneurs and the smart GPs understand where they are and where they can win and
Yeah.
stay with that and not try to adopt the model of the funder just because of the quantum of capital that's coming their way.
Well, and for example, we don't think we're very good. We would be very good Series A investors. I mean, we wouldn't be bad, but the Series A game is that you're a very famous firm and people come to you. You're Benchmark or you're Sequoia. I don't know if we're Benchmark or Sequoia. Well, I actually do know we're not, but we're very good at the seed stage. So
Yeah.
if we could raise a $400 million fund and start deploying $10 million checks, you probably shouldn't ask us to do that. You should probably give your money to Benchmark. And if you're, the seed stage, you should probably, reverse that. So what do you see happening now as we kind of look forward? We've had this crash in the market. People deployed probably too much money in 2021 at probably too high valuations. But are the decks clear? Are we, back to a more maybe serious and sober investing environment with AI underneath it? What are you feeling?
Yeah, I mean, look, 2018 to 2021 were, pretty manic, obviously peaking in 2021. Those, at least from a venture investing standpoint, I think those vintage years are going to be incredibly stressed, both because of the pace of capital being deployed, the valuations, and the fact that decision making was so hurried in terms of making decisions on companies. And I think it's going to be tough. And we're going to see this work its way through the system. The number of actually markdowns still happening. We haven't seen all the pain. Some companies will survive. By the way, a markdown itself is not a death sentence for a company. Facebook went through a markdown. Public markets see markdowns every single day.
Yeah.
It's just more of an emotional and psychological thing at the company level of, oh, I took a flat or a down round. At the end of the day, if you're a good company, you could still build a great company even with a markdown. Where things are right now, we do think things are significantly more sober than we've seen in a long time. This is my third downturn, 2000, 2009, and then now, 2022 to 2023. Couple things I think going forward. I don't think we're going to enter into another kind of tailwind environment from a macro standpoint. It's going to continue to be really tough. I think people have to reset their expectations of what to expect when investing in venture funds. A 3x net is very, very good.
Yeah.
Let me be very honest. Like the top quartile of the last 25 years has been between a 2 and a 2.5x.
Yeah.
And I think people got a little bit, probably spoiled by the fact you saw 5x, 10x, 70% IRRs. To me, that's just not real, and that's okay. But what I do like right now is we're seeing sobriety in operating and investing hygiene that we haven't seen before in a
Yeah.
long time. Now, seed is a little bit immune, and because you're not looking at public market proxies. I mean, you're pre-revenue in many cases, but certainly as a seed investor, you have to think about what the Series A investors are doing. Series A, you have to look at Series B. And because of the follow-on finance risk, I think every investor going down to the C level is being much more thoughtful in terms of the entrepreneurs and the type of models they invest in. And when you have capital scarcity in the system, as we do right now, as an entrepreneur, you're forced to do more with less. And actually, fundamentally, you build better, more resilient companies when it's not just growth at all costs. So
Yeah.
I really like that. In terms of what happens to the macro, I have no clue.
Yeah.
I have absolutely no clue. And I've realized over time, anybody that says they do, you should run the other way. But I do think that technology, I look at long-term trends, technology is getting bigger and bigger. I think AI obviously is going to be a big driver. I think that, we will see you will see a lot of funds vacate,
Yep.
and we'll just have a much better environment over the next few years in terms of having capital to deploy into companies.
Well, I think that there is a message in there of all this, portfolio and and this and your fund size and all that. If you look at what's happening on the ground, the companies that are being formed and what they're looking at and what they're thinking about, what they're probably going to do, it's just the beginning of something amazing in my opinion. And from where you are, from a perch that covers a lot more in terms of funds, you must see that.
I'm more sanguine than I have in a long time. And, I see it on the ground. I mean, people, again, overestimate what's happened without looking at what's happening right now.
Yeah.
And this has happened throughout history, right? That's why people tend to invest at the wrong times and sort of vacate the market at the wrong times. We're seeing that. I think that things are changing. I think that a lot of sophisticated investors also see what we're seeing, which is, better discipline that's occurring. And at the end of the day, the long-term trajectory of technology not only has not changed, but it's accelerating. And so that's where we get incredibly excited. But again, it's hard. This is a
Yeah.
hard business.
Yeah. If there's one takeaway, I mean, being a venture capitalist, you should, if you ever find yourself thinking you have it harder than an entrepreneur, you should leave the business, because being an entrepreneur is the hardest thing. But it's not like an easy lifestyle job. It is a very disciplined, intense, managing other people's money is a real thing, and don't take it lightly. Yeah, let's wrap up, but I wanted to, I should ask you, because of your unique position. We're a couple months past where First Republic and Silicon Valley Bank both had runs on the bank. We had this crazy fever dream time in Silicon Valley where we all woke up on a Thursday morning and the word was out. A week before, you would have never thought this, and the word goes out on Thursday that Silicon Valley Bank's in trouble and your money might not be there. And it was a crazy time. Silicon Valley Bank got taken over. FRB got acquired. What the hell happened, and where are we now? Or
Yeah, I
did that
mean,
even happen? Maybe I dreamed it. I don't know.
yeah, it feels like it. I mean, obviously, having spent time at both of those organizations, my wife working at Silicon Valley
Yeah.
Bank during this, ultimately, a lot of things obviously happened here, but this does show the psychological nature of bank runs. So SVB, by the way, was not, they were culpable, of course, of, mismanaging a balance sheet. I mean, I think that going so long on, their assets while, rates were increasing, obviously
Right.
was very, very difficult. But at the same time, you had, rates increase at an unprecedented, we haven't seen that in such a long time. I mean,
Yeah.
I think rate up again yesterday, but you had the rates, you had the decline in sort of the bond values or the asset values, and then ultimately they had to raise capital. Once they raised capital, it basically rang the alarm bells. You saw the drop in the public markets of SVB stock on that Wednesday,
Yeah.
and then once a bank run starts, at first it's illogical, but over time it becomes logical. You don't want to be the last person running out of that burning building. But what happened then is, SVB, of course, went under, and then you had the blast radius and the contagion, and First Republic and some of these other institutions. First Republic actually was a pretty well capitalized bank, had
Yeah.
low default rates, was fine, but you can't withstand bank runs. And, unfortunately, those things happened. That took out, two really significant players. FRB now acquired by JP Morgan, First Citizens buying SVB. They're still operating. But, like with any sort of crisis, they say don't let a good crisis go to waste. People worry, are there going to be options? There's always going to be other institutions. And we've seen that more recently with Citizens Bank and Stifel, HSBC,
Yeah.
MUFG, all looking to, really look at this industry and say, this is a great industry to be in. Now that we don't have these large incumbents in there, we will start acquiring people from those places and start building our own. So I think from an entrepreneur or a fund standpoint, it's
Yeah.
kind of tough right now, and it's been tough, but we will come out of this with more players, more innovation, and actually a better market because you have the advantage of much more of an oligopoly versus what may have been a monopoly or duopoly at, several months ago.
How do you think the people are doing? I'll finish. The people who were working at those places, it was obviously pretty traumatic. A lot of them, by all accounts, they were both good employers. A lot of people had been there a long time. All of a sudden, boom, they're gone.
Yeah.
It seems like a lot of them have ended up places. Like it's kind of turned out. Well, how do you think they're all doing?
Yeah, I mean, right after, of course, you major shock to the system. You don't know if you have a job. You don't know everything you've known is now gone. But I think people have started to move on. I think Citizens hired over 150 people. You have some that are at JP Morgan. Stifel hired a huge group. I can speak from my wife's standpoint. She's at First Citizens. They're doing deals. There's still this, hope of a complete rebuild of, the SVB brand. And, fundamentally, I think people are in good spirits. And I think people have landed in good places. So I feel very good about where the people are. Many of these people are friends, obviously my wife
Of course, yeah,
as well. But at the end of the day, I am seeing something very different than the overall sentiment that was back in April and May of this year.
yeah,
And it's good to see. It's good to see. And I think this will be good for the industry as
yeah.
well.
It was a crazy time. All right, well, thanks for doing this. I really appreciate it.
Yeah, it was
How do
great. A
people
lot of fun.
how do people find you? And look, we didn't touch on, and we would have been here for 4 hours, and we started going to some of the details about portfolio, how to think about things that you talk about. How do people find you or find Allocate?
Yeah, so the best way, I mean, we have Allocate is just simple, allocate.co. That's the website. A lot of what I do is through my Substack, which is ventureunlocked.substack.com. That's where I do my podcast. I also write a lot, either of those areas, or just at Samir Kaji at Twitter.
All right. Well, thank you so much. This has been the Something Venture podcast. Samir Kaji, my guest. Talk to you next time.